Okay, for the few of you that still haven't heard, interest rates have, Jared, can I get a drum roll, please? They dropped. After 7 periods in a row of holding the policy rate steady at 5%, the Bank of Canada is the second major central bank after the Swiss and the first G7 central bank to start cutting rates. On June 5th, the policy rate fell 25 basis points to 4.75%. So does that mean that the market is primed to take off? Sales are about to increase significantly, driving multiple offers and ever higher prices? Probably not. With fewer than 30% of existing mortgages holding variable products and most new mortgage holders opting for fixed, I expect the impact this change has on buying power and the effect on a market that continues to cool to be pretty negligible. As far as impact on purchasing power, this quarter point drop will equate to about $14 of savings per $100,000 of mortgage. Not a huge change. Looking at it another way, it increases purchasing power by about 3.5%, but only for the few buyers still shopping with variable products, and they're few and far between. Speaking to a number of my mortgage broker colleagues, very few of their clients are choosing to opt for the variable gamble and instead have chosen short-term fixed rates as they represent significant savings. And they're betting the overnight rates won't drop fast enough to make variable the winning bet. Fixed rates, on the other hand, aren't governed by the overnight rate, but instead by bond yields. As you can see, bond yields have dropped, falling back to March levels, giving lenders more margin to cut, but that hasn't happened yet. For fixed rates to drop, bond yields will need to drop further. Once they go below the red line on the graphic, we will see most non-insured 3 to 5 year fixed rates around or below 5%. Insured 3 to 5 year fixed rates would hit roughly 4.6% once the red line is reached. On the market side, we've hit record high inventory levels not seen in nearly 5 years thanks to seasonally low home sales in May. This is leading to a balanced market as we head into the summer, and we're seeing some softening in prices. Great news for buyers. Active listings jumped 8% from April to May, reaching 7,904, and that's up 42% from May of 2023, 19% above the 10-year average. However, sales stayed slow with 1,517 transactions in the Fraser Valley in May. That's up 3% from April, but down 11% compared to May of last year and 21% below the 10-year average. New listings dropped by 5% from April to May to 3,760. With a sales to active listing ratio of 19%, we're in balanced market territory. Homes are taking a bit longer to sell as well. Detached homes are now spending 25 days on the market, up from 23 days in April. Townhomes are at 20 days, up 1 day from April, and condos have held steady at 23 days. Benchmark prices in the Fraser Valley remain pretty flat in May. The composite benchmark price is down 0.2% from April and down 0.8% from May of last year. So what does this all actually mean? Well, anecdotally, the well-priced inventory is still moving quickly. That much hasn't changed. A well-priced A property will move quickly no matter the market, but the B properties need to be very well positioned to find an audience, and C properties are continuing to struggle unless they're exceptional deals. As always, there are variabilities per city and product type, but I'm seeing failed listings increase with inventory in almost everything. Even Langley Townhomes, previously one of the strongest performing property types in the Fraser Valley, saw a slump last month. If you're interested in digging into deeper detail, check out my STR stats page at jkre.ca. I've been in multiple offers a couple of times the past month, but the speed and intensity has definitely died down. As inventory continues to build and buyers are given more and more options, expect prices to continue to soften. May is generally the busiest month of the year as far as sales, with things settling as we head into summer. But with only marginal gains in sales, the market doesn't have the momentum to stave off the usual summer slump. We may have some sellers that decide to hang on a little longer in the hopes that lower rates will drive prices upwards, lowering inventory relative to demand. But on the other hand, you'll have buyers waiting for rates to drop to increase affordability. Ultimately, I expect it to be a wash. Sales to be slow through the month of June, leading to lower prices. In other news, housing starts are down again, with seasonally adjusted rates declining by 17% in Vancouver and 12% in Toronto. So at least we don't have to factor in a lot of new inventory skewing the data. So what do you think? Should the Bank of Canada have held rates longer, or has inflation been tamed enough? Did the drop change your plan at all, or are you holding out for lower rates? As always, if you have any questions for Fraser Valley real estate, whether that's buying, selling, or investing, don't hesitate to reach out. Thanks.